There were $1 trillion of subprime mortgages. These are mortgages that, no documentation, don't have to prove your income, very non-credit worthy. But there was a bubble mentality, a frenzy, and everyone, hey, buy a house and borrow money, fix it up, sell it for twice as much, walk away rich, and everybody was doing it. Mortgage default rates rarely get above 5%. 5% is really high in the mortgage market. So people were saying, smart people like Ben Stein, the financial analyst, but the central bank and others were like, well, okay, let's get crazy. Let's assume a 20% default rate, which has never happened, but just assume that's true. On $1 trillion of subprime mortgages, a 20% default rate would be a $200 billion loss, which was only slightly higher than the S&L crisis of the 1980s. Adjusted for inflation, it would have been a comparable loss. And the attitude was, well, we survived the 80s, we'll survive this. Yeah, it's bad, banks will take losses, stock prices go down a little bit, but we'll survive. What they missed is, yes, there was $1 trillion of subprime mortgages, but there were $6 trillion of derivatives.
Yeah.
That was invisible. So all of a sudden, 20% of that was $1.2 trillion. So you create derivatives out of thin air, and there's no limit on how many you can have. They're off balance sheet, meaning give me the balance sheet of the company, I won't see them. You have to read the footnotes and then the information behind the footnotes. So non-transparent, unregulated, no limit on size. So the crisis was actually much worse than anyone realized. And then when it started to collapse, the contagion spread throughout the financial system. My point about 2008, it was because we did not learn the lessons of 1998, and we flew right into 2008. But once again, we have not learned the lessons of 2008, and we're going to fly right into the next storm. In 1998, Wall Street got together and bailed out a hedge fund. In 2008, the central banks got together and bailed out Wall Street. Who's going to bail out the central banks? In other words, the point is each crisis is bigger than the one before. The intervention gets elevated, larger dollar amounts. And are we now at the point where there's no one left to bail us out? And one of the questions I'm asked most frequently is, okay, Jim, I kind of follow your analysis on how risk works and how complexity theory and capital markets, how that works. But where's the crisis coming from? What's going to be the catalyst? It's actually a long list. Now, student loans, there are $1.6 trillion worth of student loans. So this will go, and kind of this gets to your point, Francis, how do capital markets and money markets and Fed policy kind of leach into debt and deficits? So when a lender, credit union, or anybody, or university makes a loan to a student, and the Treasury guarantees that loan, which they do, it's off budget. Again, it's not strictly a derivative, but it is non-transparent. So then the student defaults, and the credit union, the lender, simply turns to the Treasury and said, here's your loan file, pay me. And the Treasury pays the lender because they've guaranteed the loan. Now it's on the Treasury. But until that point, that loss is not on the books of the United States government. That loss is not part of the deficit. But when the Treasury writes the check to make good on the guarantee, it does go into the deficit. So we think deficits are high now, but there's this $1 trillion tsunami of student loan losses that's going to pile on top of the structural deficits and make it even worse. So all these things are, I spend all my time analyzing these things. I see them all. I can describe them. I can see how they're going to converge into a worse crisis. But in the short run, people either ignore them or they just don't know anything about them. But why would Bernie Sanders even suggest that? And by the way, he's not alone. I think the other candidates have, Elizabeth Warren and Joe Biden and Kamala Harris, one way or another, have suggested that they would do something similar, that we need student loan relief, and that ends up going onto the budget and onto the taxpayers. But there's a school of economics, and I talked about this in Chapter 5 of my book. It's called Modern Monetary Theory, MMT for short. Everyday viewers, everyday people to know anything about it, but more to the point, economists don't know anything about it. This is a new school of economics, if you want to think of it that way. So there is this modern monetary theory, but the leading scholar of modern monetary theory is a lady named Stephanie Kelton, who's a professor at the State University of New York. But she's the financial advisor to Bernie Sanders. What modern monetary theory says is that actually there's no limit on the amount you can spend. You can spend as much as you want, and the market will either buy the debt, or if they balk, the Fed will monetize the debt. So how much debt is there relative to the size of the economy? This is called the debt to GDP ratio, but the way it's a simple fraction you learn in the 5th grade. How much debt divided by the size of the economy? So in a simple example, if you had $5 trillion of debt and a $10 trillion economy, that fraction would be 1/2. So you would say the debt to GDP ratio is 1/2 or 50%. Today, the debt is larger than the economy. That ratio is over 100%. We have round numbers, about $23 trillion of debt and about a $22 trillion economy. So the ratio is about 105%, highest since World War II. That troubles me, it troubles other economists. But my friend Stephanie says, what's the problem? You could take it to 150%, 200%, 250%. By the way, that's where Japan is. Japan's at 250%. Greece is 175% or so. Italy's 135%. They're all still standing. Go to the Ginza, it looks like Times Square. So you don't see visible signs of stress. And here's the irony. Ben Bernanke would absolutely not agree with this theory, and he said so publicly. But Professor Kelton says to Bernanke, you proved our point. You were the one who took the Fed's balance sheet and quadrupled it from 800 billion to 4.5 trillion or so. You proved that you can print trillions of dollars of money without causing inflation, without causing high interest rates, without causing a run on the bank. So all we're saying is, you did it to prop up Jamie Dimon's bonus. We wanted to do it to forgive student loans. We may have different policy objectives, but the process is the same. What's the problem? Now, of all the things I've debated, for years I was dragged into Bitcoin versus gold debates, which I thought were silly. I mean, I don't like Bitcoin, I do like gold, but it's like fish versus bicycles. I mean, the debate never made sense to me, even though I did a lot of them. Of all the things I've had to rebut, this was actually the most difficult because it's superficially appealing. First of all, legally, it is true that the Fed can take their balance sheet as high as they want. There's no legal limit on the Fed's ability to print money. It is true that Japan has a much higher debt to GDP ratio, and they're still standing. It is true that the Treasury can borrow as much as they want, subject to periodic increases in the debt ceiling, which have never been denied. And the Fed can monetize the debt. So all the elements of the thesis are actually correct. So how do you refute it? And the answer is that legally it can be done. And if your goal is to print a lot of money and forgive student loans or give a guaranteed job or guaranteed basic income, whatever it is, in theory you could do that. But there is an invisible psychological boundary, and this is what the modern monetary theorists don't understand, and I don't think Ben Bernanke understands it. There comes a time when people wake up and they say, I don't know what's going on here. I don't have a PhD, but get me out of the dollar. It doesn't. And so I'll buy gold. I'll buy silver, land, oil, natural resources. I'll buy a new car. Buy a house. Get me out of the dollar into something tangible, because I no longer trust the monetary authorities. I no longer trust the Congress. I can't believe that you're going to spend this much money without ceiling, without limit, without causing inflation. My inflationary expectations will go up. And the way to deal with that is to buy hard assets, starting with gold, but not exclusively gold. There, as I say, land, real estate, natural resources. They're all good. They're all good substitutes. At that point, interest rates will skyrocket. All of a sudden, the bond market will have difficulty selling it. The president of the Congress could take away some of the Fed's independence. All of these assumptions could come crashing down very quickly, very unexpectedly, and that's the problem with the theory.
The U.S. and Brazil are the two largest exporters of soybeans. China is the world's largest importer of soybeans. Mm-hmm. China was buying all their soybeans from the United States just as a way to kind of make it up a little bit. Like, well, we got to buy the soybeans anyway. Why not buy them from the U.S. to keep the U.S.-China trade deficit under control so it doesn't become too politically toxic? Well, as soon as Trump threw on the tariffs, China retaliated by moving their soybean orders to Brazil. Stop buying U.S. soybeans. Well, that's not a phone call. I mean, you're talking about vessels, port facilities, agriculture, trucks. How do you get the soybeans to the ports? How many do you grow? Where's the fertilizer coming from? Et cetera, et cetera. And all those parties, the shippers, the cargo, the insurance companies, and there's so many people involved, banks, letters of credit, it's just a lot involved. They don't like short-term relationships. They say, okay, I'll do it. I want a 5-year contract. And China said, okay. So they reconfigured all those transportation lanes to get the soybeans from Brazil. All of a sudden, you're a U.S. soybean grower. You say, well, what do? Well, we started selling them to the Netherlands because the Netherlands needs soybeans too. So now, but now instead of shipping them from like Port of LA to Ningbo and near Shanghai, we're shipping them from Port of Houston to, I don't know, France, or Marseille or someplace, or Rotterdam. So the point being, you completely scrambled all these supply chain relationships. I talked to the guy who, look, this is a worldwide endeavor, but he was probably the single most responsible individual for all the significant developments in the supply chain in the last 30 years. And he said to me, he said, Jim, you have to understand, it took us 30 years to build it. We blew it up in 3 years. It's not going to come back overnight. It's going to take 10 years or more to rebuild it. And what I talk about in the book is supply chain 1.0, which is 1989 to 2019. And then supply chain 2.0, which kind of starts now, but is going to go indefinitely because it's going to take a long time to put this together. It's, it's like dropping a vase and it breaks in 1,000 pieces. You can't put it back together. You got to go buy a new vase. And that's what's going on with the supply chain. There will be a supply chain, there always is, but the new supply chain will look very different from what we've just come through. Because the whole 30 years of period I'm describing was built on efficiency, lower cost, lower cost, lower cost. It was kind of the Walmart model. So yeah, just-in-time inventory, everyone knows about that, but there's something called cross-stocking. That's where a truck pulls up at a warehouse and you unload it. Instead of putting the stuff in the warehouse, you move it to another truck that then goes to a destination. The stuff never goes in the warehouse. Inventories are very expensive. They're costly to finance. You got to move the stuff around. It's called picking. Pick the stuff off the shelf with your. I used to drive a forklift, so I know a little bit about it. And put it on a truck. I used to unload trucks too. So hey, I've got 7 suppliers. Why don't I cut it down to 3 and do bigger contracts with each one and get lower unit costs? I've got 5 transportation lanes. Why don't I cut that down to 2, get everything to, Los Angeles and Seattle, as the case may be, et cetera. And they did it for 3, and they got costs lower, and Walmart and Amazon were the champions of this, but everyone else was doing it. But they missed something. What they missed was that while they were getting those unit costs lower for consumers, there were hidden costs, and the main hidden cost was you were creating greater frailty. This whole system was subject to a massive breakdown. So what happens if you have 2 suppliers and they both go on strike? What happens if you have one port of entry and it's backlogged? What happens if you've got cross-docking in warehouses and there aren't enough trucks? There are 80,000. We need 80,000 drivers. 80,000 drivers. Wish they'd hire them instead of these IRS agents. But the point being, it is breaking down all across the board. Now, can it be put back together? Yes, but the biggest difference between 2.0 and 1.0, this goes by different names. Janet Yellen called it friendshoring, and Macron called it a constellation of nations club, if you will. So you'll still have trading partners, you'll still have outsourcing, you'll still have transportation lanes, but it'll be members only. It'll be basically democratic, kind of liberal republics, Western Europe, the EU, of course, US, Canada, Australia, New Zealand, Japan, India, we expect to be included, friendly nations, but China's out. We're decoupling from them. They're decoupling from us. This isn't US driven. The US is participating, but this is what China wants too. Both sides are decoupling as fast as they can. China can develop its own network, maybe Central Asian republics, some Southeast Asian, suppliers and so forth, but they're going to lose customers. Well, most of their customers actually in the United States. We won't buy their stuff and we won't sell them our stuff, particularly high-tech stuff. So the world's going to break, and these new clubs are going to be formed, and there will be trade and there will be transportation lanes, but it'll be much more restrictive. Now, will prices be a little higher? Yes, but it'll be more secure. So the way I describe that, if you buy insurance on your house, or I buy insurance on my house, you don't want your house to burn down. You hope it doesn't. But if it does, you don't think your insurance premiums are a waste of money. Like when you write that check, you're like, that's money well spent. When you pay higher prices for consumer goods, the delta between the old price and the new price is your insurance premium for a more reliable system. And also, there's a big national security component to this. And I talk about Russia and Ukraine and China in the book. So that's all. So how the supply, what the supply chain breakdown means. Chapter 1, Chapter 2, what caused it, and we talked about that. And 3, where is it going? What are the constraints? And we talked about that. But then my editor, who's love working with us, she said, "Well, Jim, got to be a chapter on inflation." I said, "Of course we do. The supply chain breakdown is causing a lot of the inflation we see, and I'm going to write another chapter on deflation." And everyone's like, "Wait a second, why are you talking about deflation?" That's coming next. People are not ready for it. I know the inflation's here. I buy gasoline. I shop in the grocery store. I get it. I'm not. It's persistent. It's not transitory. I understand all that, but inflation has two major sources. One is the supply side, which is called cost push inflation. So that's energy price shocks. The stuff we're seeing coming out of Ukraine, fertilizer shortages, strategic metal shortages. Component suppliers who can't deliver stuff to factories in Germany and they're shutting down, et cetera. The other cause is from the demand side, and that's called demand pull inflation. Basically, it's psychological. Consumers pull demand forward. They're like, "Hey, I was thinking of buying a refrigerator. I better buy it today because the price is going to go up in 6 months." And in the 70s, we had both. It started with cost push with the Arab oil embargo, but it ended up demand pull. I was starting my career at the time. Your boss would just give you a raise. You didn't even have to ask. Inflation was going up so fast. Like, I better give this guy a raise. Like, here's another, $30,000 or whatever, because people would quit. And that sort of spun out of control until Volcker squashed it all. Right now, we do not have demand pull inflation. We don't. This is not what's going on. We do have cost push inflation. The difference is hugely important because cost push inflation from the supply side, which is, again, when I talk about in the book, it's real, prices go up, but it's self-negating. The old saying that, the cure for higher oil prices is higher oil prices, because when they get too high, people stop driving. They shut down various activities. By the way, if you're unemployed, you're not buying any gasoline because you're not going anywhere. I mean, that's kind of a nasty way of putting it, but that's how cost push inflation, tips into a recession, and then prices come down. And we saw that in 1974. You had Jerry Ford and Alan Greenspan walking around with they had these win buttons, WIN, which stood for whip inflation now, except we had a recession and prices collapsed. Now it came back by 77 with for a lot of reasons, but right now we don't have demand pull, we have cost push. It will go away when this economy goes into recession. And then we're going to be talking about disinflation and deflation, which are, kind of close cousins. And the Fed's going to be out on a limb as usual, raising rates in the face of a recession and a price collapse. And so that will be the only source of liquidity in the next crisis, because the central banks are not, if they don't normalize before the crisis, and it looks like that they won't be able to, they're going to run out of runway, and they can't expand the balance sheet beyond a small amount because they'll destroy confidence. Where does the liquidity come from? The answer is it comes from so what are the good models? What are the models that do work? What is the good science? The first thing is complexity theory. Complexity theory has a long pedigree in physics, meteorology, seismology, forest fire management, traffic, lots of fields where it's been applied with a lot of success. So why not just take complexity science and bring it over to capital markets? That's what we've done, and we're getting fantastic results. So that's the first thing. Second thing we use is something called Bayesian statistics. It's basically a mathematical model that you use when you don't have enough data. So, for example, if I've got, a million bits of data, yeah, do your correlations and regressions, that's fine. But this is and I learned this at the CIA, this is the problem we confronted after 9/11. We had one data point, 9/11. We didn't have, now Janet Yellen would say, well, wait for 10 more attacks and 30,000 dead, and then we'll have a time series and we can figure this out. No, as to paraphrase Don Rumsfeld, you go to war with the data you have. And so what you use is this kind of inferential method. And the reason statisticians dislike it is because you start with a guess, but it can be a smart guess. It can be an informed guess. The data may be scarce, but make the best guess you can. And if you have no information at all, just make it 50-50. Okay, maybe Fed's going to raise rates, maybe they're not. If you didn't have any information, you just do 50-50. But then what you do is you observe phenomena after the initial hypothesis. and then you update the original hypothesis based on the subsequent data. You ask yourself, okay, this thing happened later. What is the conditional correlation that the second thing would happen if the first thing were true or not? And then based on that, you go back and you either increase the probability of the hypothesis being correct or you decrease it. If it gets low enough, you abandon it, try something else. If it gets high enough, now you can be a little more confident in your prediction. So that's Bayesian statistics. You use it to find missing aircraft, hunt submarines. It's used for a lot of things, but you can use it in capital markets. Third thing, behavioral psychology. This has been pretty well vetted. I think most economists are familiar with it, even though they don't use it very much. But humans turn out to be a bundle of biases. We have anchoring bias. We get an idea in our heads and we can't change it. We have recency bias. We tend to be influenced by the last thing we heard. But anchoring bias is the opposite. We tend to be influenced by something we heard a long time ago. This is how you kind of have to get your mind around all these contradictions. But when you work through that, people make mistakes or exhibit bias in, turns out, very predictable ways. So factor that in. And then the fourth thing we use, and economists really hate this, is history. But history is a very valuable teacher. So those four areas, complexity theory, Bayesian statistics, behavioral psychology, and history, are the branches of science that we use. Now, what do we do with it? Well, we take it and we put it into something that would look like a pretty normal neural network. You have nodes and edges and some influence in this direction, some have a feedback loop, some influence in another direction, some are influenced by others, etc. So for Fed policy, for example, you'd set these nodes and it would include the things I mentioned earlier: inflation, deflation, job creation, economic growth, capacity, what's going on in Europe, etc. Those would all be nodes and there would be influences. But then inside the node, that's the secret sauce. That's where we have the mathematics, including some of the things I mentioned. But then you say, okay, well, how do you populate these nodes? You've got math in there, you've got equations, but where's the news come from? That's where Watson comes in. Watson's reading all these records, feeding the nodes, they're pulsing, they're putting input, and then we have these actionable cells. So, dollar, the euro dollar cross rate, the yuan dollar cross rate, yen, major benchmark bonds, yields on 10-year treasury notes, Blinds, JGBs, etc. These are sort of macro indicators, but the major benchmark bond indices, the major currency cross rates, the major policy rates, which are the short-term central bank rates, and a basket of commodities, oil, gold, and a few others. They're the things we watch. We use these neural networks I described, but they're not just kind of linear or conventional equilibrium models. They're based on the science I described. So all that good science, bringing it to a new field, which is capital markets, using what's called fuzzy cognition, neural networks, populating with Watson. This is what we do at Raven. We're very excited about it, getting great results. And this is what I use. So when I give a speech or write a book or write an article and I'm making forecasts, this is what's behind it. Our science involves complexity theory. Well, complexity theory shows that the worst thing that can happen in a system is an exponential function of scale. Scale is just how big is it. So you go to Jamie Dimon and you say, okay, Jamie, you've tripled your the gross notional value of derivatives. You've tripled your derivatives book. How much did the risk go up? Well, he would say not at all, because gross notional value is triple, but who cares? It's long, short, long, short, long, short, long, short. You net it all down. It's just a little bit of risk. Risk didn't go up at all. If you ask my my 87-year-old mother, who's not an economist, but she's a very smart lady, say, hey, Mom, I tripled the system. How much did the risk go up? She would probably use intuition and say, well, it probably tripled. Jamie Dimon's wrong. My mother's wrong. It doesn't, it's not the net, it's the gross, and it's not linear, it's exponential. In other words, if you triple the system, the growth went up by a factor of 10, 50, etc. There's some exponential function associated with that. So, people think, well, gee, in 2008, we learned our lesson. We got debt under control, we got derivatives under control. No, debt is much higher. Debt to GDP ratios are much worse. Total notional value, gross notional value of derivatives is much higher. Now, people look at the BIS statistics and say, well, the banks actually, gross notional value of derivatives has been going down, which it has, but that's misleading because they're taking a lot of that, moving it over to clearinghouses. So it's never been on the balance sheet. It's always been off balance sheet, but even if you use the footnotes, that number has gone down for banks, but that's only because they're putting it over in clearinghouses. Who's guaranteeing the clearinghouse? Notice the risk hasn't gone away. It's just been moved around. So given those metrics, debt, derivatives, and other indicia, concentration, the fact that the 5 largest banks in America have a higher percentage of total banking assets than they did in 2008, so there's more concentration. That's another risk factor. Taking that all into account, you can say that the next crisis will be exponentially worse than the last one. That's an objective statement based on complexity theory. So you either have to believe that we're never going to have a crisis, and I'm like, well, you had one in 1987, you had one in 1994, you had one in 1998, you had the dot-com crash in 2000, mortgage crash in 2007, Lehman in 2008. Don't tell me these things don't happen. They happen every 5, 6, 7 years. It's been 10 years since the last one. Doesn't mean it happens tomorrow, but nobody should be surprised if it does. So the point is, this crisis is coming because they always come, and it'll be exponentially worse because of the scaling metrics I mentioned. Who's ready for that? Well, the central banks aren't ready. In 1998, Wall Street bailed out a hedge fund, long-term capital. In 2008, the central banks bailed out Wall Street, Lehman, but Morgan Stanley was ready to fail, Goldman was ready to fail, et cetera. In 2018, 2019, sooner than later, who's going to bail out the central banks? The problem has never gone away. We just get bigger bailouts at a higher level. What's bigger than the central banks? Who can bail out the central banks? There's only one institution, one balance sheet in the world that can do that, which is the IMF. The IMF actually prints their own money. The SDR, the special drawing right. SDR is not strawberry daiquiri on the rocks. It's a special drawing right. It's world money. That's the easiest way to think about it. They do have a printing press. And so that will be the only source of liquidity in the next crisis, because the central banks are not, if they don't normalize before the crisis, and it looks like that they won't be able to, they're going to run out of runway, and they can't expand the balance sheet beyond a small amount because they'll destroy confidence. Where does the liquidity come from? The answer is it comes from the IMF. But a global recession is highly unusual, and that appears to be what we're heading for. So my forecast, I do update them, but big picture, it goes as follows. So what is Jay Powell doing? First of all, March 1st, 2022, the Fed fund policy rate, interest rates were 0. And we're now at 4.5%. Even in the Volcker days, we never went up 4.5% in 10 months. Not that fast. And so here we are. So what is Powell doing? Well, he's given 5 speeches on the subject. I don't know why Wall Street doesn't listen, but he keeps trying. He said the same thing every time. He said, inflation is job one. We're just going after inflation. Believe us. There is going to be a recession. Unemployment is going to go up. There's going to be pain. I've never heard a Fed chairman use the word pain. He used it 5 times in one paragraph in the Jackson Hole speech. And that's what we're doing. And believe us when we say it. Now, how long will he raise rates? How quickly? And what's he trying to do? Powell is trying to get to something that he calls the terminal rate. But the definition of the terminal rate is it's a rate that's high enough to cause inflation to come down on its own without further hikes. So we'll get to a level, and then inflation is coming down, by the way. And in the last 5 months, in the U.S., it's gone from about 9% to 8.7, 8.2, 7.4, 7.1. So it is coming down. Having said that, the target is 2%, and 7.1 is still a far cry from 2. So he's not there, but he's making progress. Now, so here's I hate to use the word conundrum, but it kind of is. Wall Street's saying, you're done. You did it. Mission accomplished. Inflation is coming down. You got what you wanted. Give it time. Stop raising rates. You're going to kill the economy. But the Fed is saying, well, we actually don't know. We can't untangle it. Yes, inflation is coming down. That's objective. But is it coming down because we're still raising rates? Or is it coming down because we're at the terminal rate? Those are two different things. And right now, and this is what Powell's been saying, the Fed leans to the view that they're not at the terminal rate, that inflation is coming down because they're raising rates. They have not achieved the terminal rate. So my expectation is the Fed will raise interest rates 50 basis points on February 1st, and then probably 25 basis points in March. March 22nd is the
Fed meeting after that. So those 75 plus the 450 we have now, that'll get you to 5.25. And even the more hawkish members think that that's probably the terminal rate. So, so Powell and the Fed have said, yeah, inflation's coming down, but it's because we're raising rates, not because we're at the terminal rate. We're going to get to the terminal rate, probably 2 more hikes, and then we'll pause. And then if we're right, we'll just let inflation come down on its own. And that may take a year. So all this stuff about the Fed pivot and cutting rates and all that stuff, I mean, the Fed's thinking mid 2024 before they do that. Now, Wall Street are saying, no, you're not going to get that far. You may be at the terminal rate already. You're definitely going to cause a recession. It'll be more severe than you think, and rates are going to have to come down sooner than people expect. In other words, you've already achieved the terminal rate. You just don't know it, and you'll probably be the last to know. So with Wall Street, with the cheerleaders, sending that message, but with some serious market indicators, including yield curves, sending that message. Why is Powell sticking to the game plan as I described it? And the answer goes back to 1980, believe it or not, and what's called the Volcker mistake. People forget that there was a recession in 1980. It was sharp but quick. It was over very quickly. It had nothing to do with monetary policy. The Carter administration issued some dopey regulation on a ceiling on credit card interest rates. And the industry said, fine, we're just not going to lend anybody any money. The economy fell instantly, kind of like a smaller version of what happened in 2020 with the pandemic panic. And then they said, oh, sorry, just kidding. And then they took the ceiling off and then things got back to normal. Now, this was a time when farmers around the country were driving front loaders and tractors to Washington, and they were circling the Fed building. And one guy drove his tractor up the steps of the Fed, and Volcker was being burned in effigy. That all happened. So it was a little bit of pressure. And of course, Congress was up in arms and the White House was up in arms. So Volcker, not quite panicked, but he cut interest rates 7 percentage points, not 0.7, 7 full percentage points to deal with the recession, which, number one, was unnecessary because the recession was caused by a policy blunder from the White House, which was quickly corrected. And number two, he had not won the fight against inflation. Well, after he cut rates and we came out of that very quick sort of snap recession, inflation got even worse. And that's when Volcker had to raise rates to 20%. And Volcker, in hindsight, and he said this in his last book just before he died, he said, we shouldn't have done that. We should have stuck to our inflation mission. So now Powell, remember, Powell's not an economist, he's a lawyer, so he kind of thinks like a lawyer. I can relate to that, looking at both sides. Powell does not want to be that guy. He does not want to be the guy who balks early and cuts rates, the famous Wall Street pivot, before the battle against inflation is won, because the outcome could be exactly what Volcker experienced, which is inflation wasn't done, doesn't go away, comes back stronger, and then you do have to destroy the economy, as we did in 1981-82. That was the worst recession. That was far worse than the little one in 1980. That was the worst since the Great Depression. We've managed to break that record several times since then, but at the time that was horrific. But Volcker and others have said that was a blunder he never should have done. So Powell does not want to give up the rate hikes too early because he does not want to repeat the Volcker mistake. He does not want to be that guy. And that's what's driving him, even as Wall Street screams, you're already there. So the question, so that's the lay of the land. There's the two competing sides. How does this play out? In my view, Powell probably is there. He probably is at something like a terminal rate. He probably doesn't have to raise interest rates anymore. He doesn't believe that himself. His models tell him otherwise because they're relying on the Phillips curve, which is junk science. I mean, the last time I looked at a Phillips curve, it was flat. At least where I went to school, curve was curved. This thing is flat. There is no correlation between unemployment and inflation. There just isn't. But the Fed thinks there is. So I always tell people, don't. If you want to forecast Fed policy and understand the Fed, don't think like a rational person. You have to think like the Fed. You have to get inside their heads or else you're going to get it wrong. So they're looking at unemployment, which is the lowest. The unemployment rate is the lowest since 1969. Well, if you believe in the Phillips curve, then that's a sure sign of inflation. As I say, even though it's coming down, it's still pretty high. So they think they have to keep fighting this fight. But here's what they're missing. Here's where it all falls down. Yeah, inflation as measured, CPI, PPI, personal consumption expenditure, core, non-core, year over year. There are like 20 different ways to measure it. It is coming down. But
There are two sources of inflation. And it's going to sound obvious, but you got to separate them, the supply side and the demand side. They both result in price increases, but they have completely different dynamics. Supply side inflation is what we're seeing. It's what we saw in 1974 with the Arab oil embargo during the Arab-Israeli war when they cut us off from oil. And, you had to line up for gasoline. I lived through that. Bare shelves, and you couldn't get certain things. It wasn't that every supermarket shelf was bare the way it was in East Germany in the 1950s, but something was always missing, and that's still the case today. So, of course, prices went up, and people were trying to pay whatever they had to get what they needed, and energy prices were a big driver of that. So that feeds through as a form of inflation. The other kind of inflation is from the demand side. So the supply side is called cost push. Costs go up, and they push it onto the consumers. The other kind is from the demand side. It's called demand pull. And basically, consumers have a change in mentality. They're worried about inflation. They would say, hey, I was thinking about buying a refrigerator. Gee, I better go buy it today, because if I wait for 6 months, the price is going to go up. Or apply that to anything, a new dress, new suit of clothes, whatever. And so you're pulling demand forward, and it's behavioral. And that will also drive prices up. But they're very different things. Now, cost push can morph into demand pull. That's what happened in the 70s. It started from the supply side, but by the late 70s, 80s, and Volcker, which we've just been talking about, it had tipped over into the demand side. That hasn't happened yet. We've had the supply side inflation, the cost push. It hasn't yet tipped into demand pull. It hasn't really affected consumer behavior that much in terms of people anticipating more inflation. It could, but it hasn't happened yet. Here's why that's an important distinction. Cost push inflation negates itself. The old saying that the cure for high oil prices is high oil prices, because people can't afford it. Maybe if demand is inelastic, if you got to fill up your Ford F-150 truck with gasoline to take the kids to school or go to work. But if you're unemployed, you're not buying any gas because you're not leaving the house. So it tends to negate itself, whereas demand pull feeds on itself. Powell has not made that distinction. And if I'm right, I think I am right, and the evidence backs that up, this inflation will come down, not because the Fed is raising interest rates, but because higher prices destroy demand all on their own. If I used to pay $75 to fill up my truck with gas, and now I have to pay $150, which is about right, I'll do it because I got to get to work. But that's $75 I'm not going to spend on something else. I'm not going to go out for dinner. I'm not going to go to a show, a concert, or buy a new camera, whatever it might be. So it does tend to depress demand, destroy demand, and hurt the economy. And then it slows down, and then the inflation comes down on its own. That appears to be happening. But Powell hasn't really made the distinction. He's fighting the last war. I hate to use a cliche, but he's fighting the Volcker War. And what he's got looks a little bit more like the Herbert Hoover War. That looks a little bit more like the 1930s than the 1970s. So the bottom line on all this is the Fed is going to raise rates at least twice more for the reasons I mentioned. Powell doesn't want to repeat the Volcker mistake. He thinks the battle's not won. He has to get to the terminal rate. In reality, he's probably already there, if there is such a thing as a terminal rate. It's another one of these things they made up. Inflation is coming down, and so will probably continue, but for really bad reasons. I would increase my allocation to cash. I'll stick with cash, but let me kind of put that in a context. The most powerful investment tool we have is diversification. Problem is people don't understand what diversification means. So I run into people all the time. They say, well, I'm completely diversified. I own 50 different stocks in 10 different sectors, semiconductors, consumer non-durables, minerals, et cetera. And I say, you're not diversified. You may own 50 stocks in 10 sectors, but you have one asset class, stocks, which are subject to conditional correlation. In calm markets, they're idiosyncratic, but in panics, they all go down together, or in bubbles, they all go up together. So you're not diversified. So what is diversification? Diversification is having slices of asset classes that are minimally correlated. There's probably not zero, but as close to zero as you can get. So what would that be? You'd have a slice of gold, but I recommend 10%. I have some strong views on gold, and I've written a lot about it, but people are surprised to hear me say 10%. Like, oh, Jim, why isn't it 50% or 100% if you believe all this? Well, I do believe it. I wouldn't say it if I didn't, but you don't want to be 100% in anything. You don't want to be 50% in anything. 10% is fine. If I'm wrong, you won't get hurt. And if I'm right, you're going to make so much money that it'll actually kind of be the insurance on the rest of your portfolio. But that leaves 90%. So I would have a large slug in cash, maybe 30%. And people say, well, wait a second. Banks paying me 25 basis points, stock market's going up. Why would I want to be in cash? That's horrible. A couple of things. Number one, the stock market might not always go up. Cash is the opposite of leverage. So leverage increases the volatility of the rest of the portfolio. You'll get much bigger returns, but you'll have much bigger losses. If you have a slice of cash and you've got a volatile asset over here, which are stocks, and another volatile asset over here, gold's fairly volatile. If you got that volatility and you have cash, it will reduce the overall volatility so you can sleep better at night. Cash is a great asset in deflation. And if you're talking about inflation, which is here, then you got to deal with that. But don't rule out deflation. If we go into a recession because the Fed over tightens, or, the thing about the inflation, just a quick aside, it comes in two flavors. There's cost push and demand pull. Demand pull is when individuals are worried about inflation and they start accelerating purchases, like, hey, I better go buy that washing machine right now because the price is going up, or better go buy that house right now because the price is going up. That's demand pull. Cost push comes from the supply side, not the demand side. And that's what we're seeing because of what we talked about, supply chain, energy cost. The Fed can't drill for oil. Raising interest rates doesn't get you more oil or natural gas. So the Fed can't do anything about it except kill the economy. Yeah, and that'll cool it off. But when you pay, I put gas in my car. I don't just read about this stuff. It used to be $45. Now it's about $75. Multiply that by 200 million cars across America. What happens is it reduces your discretionary income. If you're paying another $30 at the pump twice a week, then you're not going to go out to dinner Friday night. You're not going to, take a vacation, whatever it may be. So that depresses all those other areas. So there is this recursive function. So don't rule out deflation down the road. Not right away, but maybe next year. So cash. But here's the biggest value of cash. It gives you optionality. People don't understand this. What if I said to you, hey, I'll sell you a call option, an at the market call option on every asset class in the world? You go, gee, that sounds kind of valuable. Well, that's what cash is. When things are crashing, you're the one who can go shopping. And nobody's better at this than Warren Buffett. He's got his cash level at Berkshire Hathaway is at an all-time high. So there's a place for that. You can have some stocks, but I would look at the energy sector. I mean, I actually built and I own the largest non-commercial solar module field in New England. And I run my house off it. It produces about 7.5 kilowatt hours. So I know a little bit about it. And what I know is it doesn't work at night. It doesn't work in snow. It doesn't work in rain. It doesn't work in really cloudy days. By the way, you don't run your house off of solar modules. You run your house off of batteries.
Yeah.
And then the modules charge the batteries. So you watch the battery level. That's how you manage it. So it works fine. But if you think you can run cities with that, forget it. So it's just not practical at that scale, even if you thought it was. And it isn't. That's very clear. But here comes wind turbines and solar. And I'm not against it. Like I say, I own one. But they're not scalable. They're intermittent. And they don't give you the base power, baseline power you need to run a modern power grid. Meanwhile, here's global demand. Okay, so the gap's getting bigger. It's not getting smaller. Renewables, whatever the pros and cons, are not closing the gap. The gap's getting bigger. There is no substitute for oil and natural gas and uranium. You got to put uranium in the mix. And hydro, if you live in Quebec, that's great. A lot of hydro, but not so much in the desert. And I've spoken to, without mentioning names, I would say you can go no higher in terms of who knows, let's just say board members of the 5 biggest oil companies in the world who said, yeah, as he said, we talk about that, but we can't say it publicly because we'll be, dragged, chained and dragged through the streets. But those are just the facts. So therefore, if you have an oil sector that's been bashed by the climate alarmists, but you can't do without it, which is true, buy some oil companies, when they're, so there's your stock portfolio. Private equity, venture, real estate, not commercial, but residential, yes. And, farmland, that's one of the hottest asset categories, and gold. So that's diversification. And that's the kind of portfolio you want, the kind of seasoned to taste. So the question is, will the Fed go down that path, do what they have to do the only thing they can do to subdue inflation at the cost of a very severe recession and something like a stock market crash? Or
Will they see that coming? They'll be the last to know. We'll all see it before they do, but they'll be the last to know. It's because they rely on flood models, and they're kind of in their own economic forecasting bubble, and they have very defective ways of thinking about the economy, and they're very much a creature of inertia. There are a whole lot of reasons why the Fed is not nimble. It's kind of quite the opposite. But they'll see it eventually, probably when it's too late. And will they balk at that point and stop rate hikes and maybe even reduce rates? That could save us from the recession, but that will just amplify the inflation. So rather than say which one's going to happen, I prefer to lay out those two paths and then just watch it very carefully. But more to the point, we've seen this movie before. This is a replay, and I think it's on, like you hit the remote control for double or triple speed. It's going to happen faster, but this is a replay of everything that happened from 2013 to 2019 and into 2020, which was, I'll just go through it quickly. So 2013, May, Bernanke says we're going to taper asset purchases. That's money printing, quantitative easing, whatever you want to call it. The market, tanks, bonds go down. Everyone's like, oh, it's over. Bernanke balked. But finally, in November 2013, they said, okay, the taper begins. They were still printing money, but at a slower rate, and that matters. That went on until late 2014. The taper was over. They stopped buying new assets. They said, okay, here come the interest rate hikes. Except they didn't come for another year. It wasn't until December 2015 that then Janet Yellen finally raised rates. And then another year for the second rate increase. So it was December 2016. So it was really, really slow. Took 2.5 years, but they got to 2 rate hikes. But then here comes Jay Powell. And then like clockwork, boom, 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 25 basis point hikes every meeting. And all the Fed was trying to do was to get back to normal. They were trying to get interest rates to maybe 2.25, 2.5, get the balance sheet down to, something like 2.5 trillion. They never specified it, but that would have been a reasonable level. So, okay, now interest rates are kind of normal, 2.5, balance sheet's down around 2.5 trillion. We're back to normal. We finally got through the global financial crisis of 2008. We undid all that stuff. Well, what happened? From October 1st, 2018 to December 24th, 2018, the stock market dropped 20%. That was the December 24th, 2018, we call it the Christmas Eve massacre. Stock market went down 3% in one day. But the Fed was tightening into the weakness, as they always do. And the last interest rate hike, it was December 16th or 17th, within a day or two, but mid-December 2018, they were still hiking and raising rates. And that was the last straw. And then the market just tanked. And then finally, Jay Powell got the message. First week of January 2019, he says, okay, that's it. We're going to be patient. Use the word patient. It's one of these code words. You have to get the code book out and see what it means. But patient means we won't raise rates again without giving you advance warning so you can get out of your carry trades or whatever. And then he went further, said, looks like we got to cut rates. And they did. And then by early 2020, here comes the pandemic. And then they took rates all the way back to zero. And then they started QE, 6, 7, call it what you want. They took the balance sheet to $7.5 trillion after getting it down to $3.5 trillion. So look at that whole sequence from 2013 to early 2020, including the pandemic. What happened? They tapered the asset purchases. They raised rates. They sank the stock market. Then they said, okay, no more rate hikes. Then they cut rates. And then they started QE. And by April 2020, where were we? Zero rates, back down to zero, and the balance sheet was $7.5 trillion after getting down to about $3.5 trillion. So that was a big circle. They ended up back where they started from. But the point being, they failed to normalize. They failed to get rates where they wanted. They failed to get the balance sheet where they wanted. They did sink the stock market. Okay, now 2 years forward, here we are again. What are we doing? They just raised rates at the March meeting. They're going to raise them again in May. And that's the easiest forecast I've ever made. 50 basis points, May 4th. Boom. You can count on it. And they're going to announce. By the way, I don't have a crystal ball. The Fed told us this. I mean, that's the thing about the Fed. They may be wrong, but they're transparently wrong. So they tell you what mistakes they're going to make in advance. So that's the Fed forecasting is actually fairly straightforward because you just have to believe them. So they're going to raise rates again in May, probably 50 basis points. They're going to announce a reduction in the balance sheet. Whether they actually start it in May, they probably will. $100 billion a month reduction in asset purchases. So that's QT, quantitative tightening. In other words, they're running the same playbook They tried to run, or they started to run in 2013, 2014. They failed the last time. Why do they think they're going to be any more successful this time? Why do they think they can get out of this? And the answer is, pardon me, the answer is they cannot without a recession. They can normalize rates in the balance sheet, and they can stop inflation, but not without causing recession and not without causing a stock market crash. So the big question for the next year is, will the Fed do that? And they may. Or will they balk again, at which point you might rescue the market, but the inflation is just going to go wild. That's the debate. But the thing is about framing it that way, you've got two paths, and we'll get signals along the way. We won't be the last to know. The Fed will, but we won't. You'll be able to see this coming.